All right, hey y'all. I had a great conversation with Lauren this morning, um, on the back end of a great conversation with AJ about what's happening in the mortgage market. And if you've been paying attention, we've been seeing some really good indicators that are showing that because of a job report that recently came out, showing that the jobs were significantly under the expectations of what the jobs were expected to be, plus some adjusting of job numbers over the last couple of months that in general has shown that the market is not as strong as it's been over the last few years, which sounds bad, but this also means that as we're looking at all factors, unemployment, GDP, gross domestic product, and inflation, that the stronger these numbers are, then the higher inflation is, the higher mortgage rates are going to stay high. And so what we're seeing now is that these numbers are coming out showing that after a few years roughly that the market is not that strong. And what that means is subsequently when the market's not as strong, then that means mortgage rates typically are going to get a little bit better following signals from the bond market. So we are starting to see mortgage rates trickle down just a hair, not a ton, to AJ's point this morning, about every 30 bips or 33 bips or so. I think he said it was about like a third of a point, which means every time about 100 points move on the bond market that go up, roughly, but not always calculated correctly, about an eighth of a percent of points come down on the interest rates. For example, coming down from about 6.5 to 6 3/8 per se. Was 1 point or an eighth of a percent. So that being said, what we're seeing right now is that mortgage rates are likely starting to hair down just a little bit. Now, that information isn't going to be getting out to the public until it's been there for a little while. So for one, I would encourage you all to start having those conversations right now that competition is really low. Inventory is at about a 14-year high, I believe it was last time I checked. And so this information means that like 26 bips up right now as of today. That means that it's a really good time to buy because mortgage rates are starting to kind of trickle down and competition is relatively low. Now, what's likely to happen come January or February, but not for certain, is that competition is going to pick up quite a bit because as a cyclical kind of rhythm, people start shopping again in January or February. In addition to that, if that's on the tail end of news, CNBC, Fox, whoever else finally getting out there and saying what you and I already know today that mortgage rates are starting to get better. What that means is competition is going to get a lot heavier relatively soon. Now, I bring up this trend right here because it's super helpful because this is showing you about what's taking place on this graphic. Every year, the market in real estate goes up sustainably about 4%. Now, granted, if inflation's only going up, um, 2 or 3%, and let's say compensation or salaries or income is going up 2 to 3%. Housing always seems to exceed what's happening, and there's so that means that there's a greater divide consistently and a bigger picture that housing becomes less and less affordable because it's the best investment. And if it's consistently compounded as the best investment, that means it's going to become less approachable. And unfortunately, the commoditization of housing, it being a less approachable investment, it's also kind of a really big deal. Shelter, food, clothes, right? That housing becomes or consistently stays affordable. That being said, this is a 4% trend showing you what's normal, reasonable in this market historically over the last 100 years. And so this chart is showing you from about 1990 to 2025 how property values have trended at times above that 4% trend. So, for example, between 2003 to 2006, you could see we've trended quite a bit above, about 21% above with housing prices. This was when a lot of mortgage rates were, you know, relatively approachable, but also it was just really easy to get a mortgage, like way too easy, like fog of mirror easy to get a mortgage. Then of course that bubble popped. It was noteworthy. It was significant. We were 21% above the trend. We trended below for a long time, and then so as property values got more expensive, like so let's say for example from 2016 to 2019, people said housing has gotten expensive. It hadn't gotten expensive at that time as much as it had gotten less cheap. Now, by about 2021 to 2022, we were right about at those 4% trend lines. And then, of course, 21, 22, 23, well, actually, I should say around 19, 20, 21, we saw a significant increase in housing prices because the Federal Reserve was kind of keeping things artificially low and mortgage rates were artificially low or really significantly lower than they should have been. Then we had the COVID explosion of demand during that time. And so on the tail end of that, for the last few years, what we're seeing is that housing values have slowed down quite a bit. So all that to say, here was the question Lauren had. Hey, we just had this economics class. If the mortgage rates are starting to come down, doesn't that mean that housing values will start ticking back up? And isn't this a bad thing? I wanted to show you what's happening right here. So this is showing between 2023 to 2024, 2025, a much more moderate trend. Um, and in our area, I would say that we've, even seen less of a trend. I have a lot of clients calling me who have purchased a house in 2022 and then in 2025. I mean, we're barely enough above the trend for them to break even in a lot of these situations. So that being said, this is what's giving confidence with all other economic factors combined that it's probably a good time for the Federal Reserve to start adjusting their rate, and that being trickled and triggered by other factors, GDP, inflation, unemployment, that it's a higher probability that mortgage rates start to come down. But the key question here is, but if we are already trending above the 4% valuation and interest rates are starting to come down, what is the difference? Here is the huge difference. It's specifically inventory. For the last decade or more, 12, 13, 14 years, inventory has been a lot lower during, this high demand season, than it is in a healthy market. It wasn't a balanced market, it was a seller's market for a long, long time. Now inventory is continuing to creep up. There's a lot of new construction starts that are still projected to take place quarter one, quarter two. A lot more people are feeling comfortable listing their house and moving through the move up marketplace. Placeholders, or sorry, people that have been kind of on the fence for the last few years. So we see a lot more inventory, and what that means is as mortgage rates come down, if there's a ton of inventory, if you're looking at kind of a supply and demand XY curve and kind of some microeconomic illustrations, if there's very limited supply and a very high demand, then those prices are going to go up significantly. If there is a lot of demand, but also a lot of supply, which is what we're seeing right now, it's a lot lower of a probability that prices will spike up. And so right now, what we're hoping to see, and just to kind of show what could happen, and this is a kind of a projection of maybe idealism, but what's very likely is that unlike this other chart, which is showing that we were, in 2005, 2006, 21% above the trend, and then in 2023 to 2024, almost 10% above this 4% trend line, and then closer to 8.3% above the trend line. What should happen as now interest rates are even trickling down, but inventory has picked up quite a bit, is that over time, property values may likely still increase closer to 1, 2, maybe 3% per year, but underneath that 4% trend line. If property values are increasing less than the 4% trend line because we have a significant amount of inventory of supply to supply the demand that's needed as mortgage rates trickle down, then the probability is, and my hope is, that we will see home values continue to increase, but not at a crazy level, and that they will increase less than the 4% average, so that there is this proverbial landing of the plane per se as it comes to the housing market, and that we come closer and closer to this trend line. And maybe we will continue to stay above this trend line for some time. Maybe this trend line will change from 4% closer to an average of 4.2, 4.4, and that will impact this. And yes, on a larger scale, if salaries, if income doesn't increase as quickly as housing, there's still a big picture problem here on what's going to happen with the affordability of housing, whether it's changing the way homes get financed over a 30 or a 35 or a 40 year, or some other government influence on making housing more affordable. But that being said, here's the hope, is that even if interest rates decrease and home prices increase, that we're going to increase at a much more sustainable trend, which is better for the housing market in general. Hopefully, you were there at that economics breakdown that we did with myself and Terry Wise and a lot of other smart people that were here in the room with us. But here's the takeaway. Here's the action. If you're in this market, what I would encourage you to do is be the person, be the economist of choice, per se, as Gary Keller used to say, that we're staying ahead of these conversations such that when people have a demand in their life and you are the one on social media in person, in networking, at the open houses, communicating what's happening before the market is communicating what's happening, then they have the opportunity to maximize the market and not be just one more person competing when the market's a lot more competitive come January or February. Even with increased inventory, right now is a killer time because primarily mortgage rates are starting to creep down and have, I think they're now at a 2025 low right now, and inventory is at a 14-year high. This is when you want your clients to be jumping in to the market. This is when you want to take advantage of the opportunity to buy because every year, if you've been a real estate agent for some time, what happens is everybody jumps on board January, February and says, all right, we've had a conversation about our New Year's resolutions. Now we're ready to jump into the market. And by then, reasonably, real estate agents are saying, "Hey, where were you 2 or 3 months ago? I'm ready. I'm here. I'm going to help you now. Let's get it. Let's help you get into a new home, make this transition." But unless you're a buy sell, which is a whole kind of different conversation with a lot of other potential solutions that if you have questions on, I'm happy to answer for you. Right now, it's just a killer time to be buying, and I think comparatively, it's going to be a better time than it might be in the spring when the rates might be even marginally lower. But that competition is going to be a lot higher. So, to answer Lauren's question, there you have it. I know it's a lot of information, but wanted to make sure that as your clients have questions, as you have questions, that you feel that you have the information to help them make the best decision for them and to maximize that opportunity for yourself. All right, talk to y'all soon.